Welcome to The Deal. I'm Kathleen Flynn, and I'm reporting from The Deal's M&A Outlook 2009 conference. And I'm talking with Jim Rosener, who's at Pepper Hamilton. Jim, you focus on distressed companies, so I would imagine at some point you're having a bit of a field day here.
Well, I mean, the M&A market really, follows the cycle, and when the credit markets are bad and the prices are down and companies really don't have markets, they tend to need to consolidate. And that's what we're starting to see now, and usually at distressed prices when people need to raise cash for the rest of their businesses. Companies are selling their non-strategic assets, their non-core assets. With the run up in prices of companies 2, 3, 4 years ago, a lot of those are coming to the end of their credit availability and needing to sell to pay back debt. They've done dividend recaps, they've leveraged 7 or 8 times, and they just can't sustain that on today's economic climate. So, combination of big companies trying to slim down and get rid of non-core assets, and private equity portfolio companies that are not able to fund debt that's coming due is creating a lot of product availability, assuming that there is some credit market that comes back, so people can buy those at hopefully attractive prices. We see that coming, and I have already seen it.
Well, let's talk a little bit about valuations, because I keep hearing that it's a particularly tough time to make valuations because there's so much uncertainty and unpredictability in the market. How do you arrive at valuations and the kinds of deals that you're doing?
Well, it depends on the deal. If it's a carve out from a company, they're trying to get rid of a non-core asset, strategic asset, valuation becomes a lot less important compared to the certainty of getting the deal done, reliability of the buyer to do the deal, maintain the employees, create some space between when it was part of the larger company reputationally till when people have to make changes to the way it was operated. Those tend to be without value. It's the intangibles that really matter. On the distressed private equity, it's going to be based on what the debt markets will support, what the debt market's going to require to get the debt paid back, so they'll release the lien so you can buy the company. And it's not a race to pay the highest price, it's a race to get rid of the asset and find a buyer who can reliably do it.
And what about the availability of financing? Are you seeing a lot of deals contingent on getting financing?
People are trying to put financing contingency. We're working on a deal right now with a financing contingency, but it's the only buyer, so we'll go forward with that. Other deals we're seeing the private equity funds that I represent having to commit the entire purchase price in equity and deal with the buyout themselves, bridge the purchase and finance it later where there's no risk to the seller. That's a trade-off between a more attractive price. It tends to be certainty of the deal, speed to closure, but there is risk on there being a credit market to take out your equity that you've put in.
And are there particular sectors that you're finding deals particularly promising, areas that you're looking at?
I mean, I think that we're seeing it in the tech sector. A lot of companies who bulked up in the tech sector are trying to get rid of those kinds of assets. Manufacturing assets on the distressed side, continue. The auto industry, I was talking to a couple people today, that still goes through an incredible amount of stress, and we're likely to see bankruptcies from the biggest in the industry to all the tier 1 and tier 2 players, and that doesn't seem to be unabated. I mean, we went through 3 years of that. It seems to be getting more distressed, not less.
We've got a new administration. Mm-hmm. What are your expectations for an Obama administration, and how do you think it will affect tech deal making?
I think that if the credit markets come back, the M&A markets will come back, and he's certainly, like anybody who is going to replace the current administration, is focused on that, just like the current is. I think for the infrastructure, we're going to see a lot on energy, wind, solar. We're going to see a lot of investment in technology for infrastructure. that's where the stimulus package is going to be focused, I think, and that should create opportunity for consolidation and development in that area.
All right, great. Thank you very much, Jim Rosener from Pepper Hamilton, and thank you for watching The Deal. I'm Mary Kathleen Flynn.